Welcome back to Part 2 with Paolo Boero, Episode 4 of Navigating Complexity, hosted by Matt McDonald and Dan Dillard. In this episode, you'll learn more about Paolo Boero and Matt McDonald, two entrepreneurs whose careers intersected in Austin, Texas, and have since charted parallel paths in real estate and venture capital. Paolo shares his early experiences scaling a vertically integrated real estate business during Austin's explosive growth, while Matt reflects on his transition from leading a tech startup to navigating real estate investments. Together, they discuss how inefficiencies in real estate operations inspired them to embrace technology, partner with startups, and eventually evolve into venture capitalists. We'll explore their unique investment strategies, the dynamics of LPs and GPs, and how adapting to market cycles has positioned them to thrive in today's changing economic landscape. Let's get started.
Welcome back, guys. Looking forward to the rest of this conversation. When we last were chatting, about, Paolo, your first endeavor into entrepreneurship and what that looked like with those partners. And then we started hinting at, then that moved on. So I want to pick back up how that moved on from there to what you guys are doing now, how you guys met.
Dan and Matt welcome Paolo Boero back, continuing the conversation about his entrepreneurial journey. Paolo recounts meeting Matt McDonald in Austin, where they discovered parallel career paths. Paolo was pursuing business school and managing his real estate venture, while Matt was transitioning from his tech startup, Famigo, and exploring law school.
Well, Matt and I met outside of business. One of my best friends from growing up went to college with Matt and introduced us when we were both sort of, making our way into Austin. And so we were sort of running parallel paths in many ways. Like Matt, had you sold the business or?
No, I was still operating at that point.
Yeah, so you were it was like pretty much close to a sale. Like it sounded like you sold like 6 months later or something like that.
Yeah, we had it was funny. It was eerily parallel, right? Because I was starting law school, right? And you were doing Old 300 and business school, and I was doing Famigo and law school. And so it was sort of like, oh man, here's somebody who's sort of like on my wavelength. And then the other thing that I remember, like when you first moved here, because I got here in 2011, we also both longboarded. I was like, oh, this is like a pretty funny set of circumstances for, two guys in their 30s.
Yeah. I think not long after you had left Flamingo and then were launching sort of the family office, we were sort of just growing. But our business was very much fake it till you make it. Right. We didn't have any real backers at the time. And so we were syndicating smaller deals.
Bootstrapping everything.
Paolo explains how his early real estate strategy targeted Austin's growth in 2014. Without institutional backing, his team began acquiring smaller multifamily properties, mostly Class C buildings, 1960s and 70s vintage. Facing a lack of reliable vendors for property and construction management, they vertically integrated operations, handling everything in-house. Matt notes the inherent inefficiencies in real estate at the time, inspiring discussions on applying technology to manage operations and improve returns.
What essentially happened was we knew there was an opportunity in multifamily. We felt very strongly about the growth of Austin. This is back in 2014. It wasn't necessarily that we wanted to buy small multifamily. We would have bought institutional level multifamily if we had, the money backing us, but started out buying a lot of smaller multifamily. And because we couldn't really find good vendors, construction management or property management,
right. Explain what Class C first.
Class C, sort of older properties, 70s, 60s vintage, which there were a ton of here in Austin. And so in order to sort of execute on our value proposition, we had to vertically integrate. And what that meant was basically the three of us do everything. Essentially did a property management, we did construction management, we did maintenance, we did everything in-house.
What's interesting about that is I interviewed a couple hundred founders at least, but it's one of the themes that I'm recognizing is like, it's a nice learning experience. You get a lot of, there's a market that's unserved and there's it's because some people have moved on to the institutional side and they want the economies of scale, but it still leaves this void. And so you can go fill that, serve it, and at the same time, you're picking up knowledge and learning and strategies and so on. So it's kind of your growing learning path. It's where you're cutting your teeth to get to the next level is what it sounds like, or at least similarity to some of the other stories I've listened to in the founder path.
Yeah, 100%. I think we didn't really know how much work it was going to be or how difficult it was, especially like property management or any of these businesses. Yep. But I think when we went in, we knew it was going to be difficult to scale. But what we didn't realize, I think, was our investors who invested in us doing this strategy would latch on to it in the way they did.
Okay.
And sort of mandated that we stay in that space.
Oh, well, okay.
So that's how we got our first institutional fund. We basically were out there buying these 30 unit, sometimes duplexes, fourplexes, properties and managing them. Most of them are unlevered, difficult from a return perspective. We spun what we saw as an opportunity. We said, well, we're providing sophistication to an area where there is really none.
Right.
And we're much more attuned to sort of market rents from being on the ground and doing this full time than these sort of mom and pop operators and other people were. Mm-hmm. There's also a benefit where we were able to leverage and sell back to those mom and pop operators who were accessing cheaper debt because they were personally guaranteeing, and as opposed to taking commercial debt, mm-hmm. which was like at any given time 100 basis points higher. Mm-hmm. So they were able to make the returns work, and you could get that arbitrage from a sale perspective. So
before you continue, I have a question. You said most of these were unlevered and that made it difficult. Can you explain to the audience what unlevered means and also why that made it difficult?
Yeah, unlevered meaning zero debt.
Paolo explains the challenges and strategies involved in scaling real estate investments for smaller properties. Commercial loans typically require a minimum of $1 million, but the properties being purchased were often valued below this threshold, making traditional financing difficult. Smaller assets like fourplexes are harder to underwrite because a single vacancy significantly impacts occupancy rates. For the sake of math, a single vacancy in a fourplex would make the total occupancy just 75%. To address this, they connected with larger family offices and institutions willing to invest all cash, avoiding the need for traditional loans. While this approach reduced financial leverage, typically a driver of high returns, it gave them strong purchasing power. Despite the challenge of achieving higher IRRs, or internal rate of returns without leverage, favorable timing and strong execution led to unlevered returns of around 30%. This success enabled them to raise institutional capital and scale their efforts significantly.
And during that time, you said you were 6 months away from the sale, and you said Famigo,
yeah, software company. Okay. Yeah, and I think, you mentioned timing, right? I think that's the important piece of the context here, right? It's Austin, it's 2014, and I wish I started a couple of years earlier, but it didn't take a genius, right, to see that there was an opportunity. But where real estate is really difficult is in the execution, and so it was about the same time where I was working at Notley at the time and investing directly into real estate and into funds and into different strategies, right, to try and understand where was the real opportunity, so that, if I were to go apply myself as a sponsor, what would be sort of the best thesis, right? Mm-hmm. And so at that point, we were kicking around some of these ideas, but I think also in the background of all of Paolo and I's conversations was technology, coming from technology and coming from a VC background, right? And then looking at real estate, you're sort of dumbstruck, right, by how little technology actually exists and how inefficient it is, right? You just can't help but think like, well, gosh, if you use technology, maybe you could manage that 80 unit property, right? Or something like that. Those two things were sort of converging for me right around that time. And that sort of started to evolve into Geyser and into some angel deals. And then ultimately,
and Geyser being your next business.
Yeah, being the development company.
I was just trying to get a little background of where you were in your journey.
I looked at it as you mentioned that there's this sort of proving ground for entrepreneurs, right? And it's I thought of it as lean real estate, right? It was similar to software where you would, take some sort of small risk, right? And then you'd sort of ramp it up and up over time as you got more confident in your thesis or, the product market fit. And I think that was really sort of how I approached real estate, right? Coming from technology, was doing bigger and bigger projects. And then we started co-investing or investing in each other's deals, shortly after that too.
We got enough scale or sort of enough of a track record to raise a fund in around the time I graduated from MBA, which was 2016. The sort of funny thing that happened was we saw this first stage as proof of concept. We had always the intention of going into institutional size multifamily. And the reason why we didn't do it in the beginning was because of our sort of lack of funding. When it came to, hey, let's do a fund, our investors who had seen us execute on a lot of this smaller multifamily said, well, we want you to continue to do this, but at scale. That was a very 10,000 foot view decision from the sort of LPs that were backing us in the fund. We were trying to explain to them that it's very difficult to aggregate like 100 properties that have no economies of scale for on-site.
Right.
Us being vertically integrated, it's a logistical nightmare. Right. Like anytime something breaks, we've got to call somebody, we got to dispatch maintenance. Anytime we're leasing an apartment, we got to dispatch leasing. Anytime, our property managers now have to figure out how to spend their time between 5 or 6, properties, right? Then we've got to really be thoughtful about a concentration, where we're buying so that, you don't get too far spread apart. It also makes us really constrained geographically, right?
Labor intensive, sounds like just
insanely labor intensive.
Manpower intensive, so.
And we were buying in the most operationally intensive asset class, which is Class C. Listen, we'd love to buy like closer to core, newer assets where there isn't so much deferred maintenance. Our ideas kind of fell on deaf ears in that first fund because they were like, well, this is what you guys have done in the past. Right. Continue to do this. This is what our investors will invest in.
Right.
And it was kind of just too big of an opportunity to pass up. So our attitude was, well, we'll figure it out.
Right.
Paolo describes the logistical challenges of scaling with small, operationally intensive assets. The need to dispatch maintenance and leasing across multiple scattered properties created inefficiencies. Despite these hurdles, Paolo's team achieved impressive returns, attracting institutional capital to their first fund. However, the structure forced them to continue focusing on small properties, even though they recognized the difficulties in aggregating them efficiently.
The common entrepreneur attitude, by the way.
Yeah, which is sort of how we've approached, sort of everything from me leaving Guggenheim and going, it was just like, I guess we'll another thing to figure out.
Yeah.
I don't think we thought it was going to be nearly as challenging as it was. And we had close to 100 properties. Like I said, all of this makeup.
About 80 hours a week of your time as well.
It was impossible. Given that it was a first fund, we had to give up some pretty substantial economics to the LP that raised the capital for us.
Yeah.
So we couldn't really afford much infrastructure. And so we were hiring people that we could afford, not that we needed.
Right.
And just continuing to sort of get from A to B, then upgrade from B to C. And so it was difficult to sort of create sustainable processes.
Yeah.
We had a complete lack of connectivity between the ecosystem just because of how unscalable everything was,
right.
How operationally intensive our asset classes was. So we went through every iteration. We went through people, we said, all right, we need to just bite the bullet and see if we can, hire ahead and find better people. The problem being, if you're hiring, like property management, for example, good property managers want to sit in scalable, nice Class A properties, right? For the most part. And so the talent available for a Class C sort of affordable housing 30-unit building, or to run around in between 8 of them is just not the same.
Yeah.
And you can't pay as much.
Right.
So that was another sort of issue that was difficult to figure out. And then we thought, oh, well, maybe incentives will help. Like if we properly incentivize, you know, our leasing agents, our maintenance people to keep costs low, or you know, our leasing people to be more proactive, that will help. I think it helped somewhat, but it wasn't enough.
Right.
And I think the only thing that we sort of turned to that we figured could help was technology. So that was sort of the evolution of how we got involved in technology in the first place. Yeah. We looked at what was out there, and there were sort of really big gaps in, we were using Appfolio at the time, still are using that, which is a property management system. There were sort of gaps in all of these different PMSs where we had to figure out quickly how to fix those in order for us to just operate. Right. So we built a software, which was another sort of crazy endeavor, because we're not product people. We just knew, hey, we need this thing here in this particular part of the business to help us.
Faced with inefficiencies, Paolo's team explored technology to manage their portfolio. They developed custom solutions to address gaps in property management systems, but realized their expertise lay in operations, not product development. This pivot led them back to partner with startups, providing feedback to improve external tech solutions.
What I find interesting about this, because what you're articulating is, I think the theory of what most people going into business think, right? We're going to go raise all this money, we're going to go build this, and it'll be easy. But there's margins involved, is what you're saying. You got the LPs that had certain things, and so even though you raise the money, you still have only so much to work with, and that still causes a ton of different works, and you still have to be very, very creative with whatever's left, is what I'm hearing. And to the point, to say, okay, we've pretty much squeezed everything we can out of the budget, and we've used those softwares that are available. Now we got to go build one, because there's some that it'll make such a difference in our bottom line that it's worth that investment.
Yeah, we thought so. I think
and that's the founder's story.
Bottom line in lives, right? I mean, I always ask people, like, what's the burning customer need, right? And like, I think a big part of why you guys were successful in that endeavor is that you actually had to do it, right? Like, I remember going and visiting one of your offices behind Juan and Emilion, right? They're like in a burrito shop, and it's like there's people coming in to collect rent. Some guy's dropping off a ladder, right? But if you don't understand what those workflows are and what the problems are, and a sort of visceral way, right, it's really hard to know what problems to solve, right, and what people are literally, they'll do anything, right, to not have to do X anymore.
Yeah, it's an iterative process. I think you're going in, assumptions are almost never right. From experience, you can start to build better going in. Assumptions is all you can really do, but I think what makes it work is to constantly be testing those assumptions and improving on what you thought was the right thing to do. And all you can operate off of is the information you have at the time.
Well, and I think that's an interesting point, because I've also seen and worked with people that really do a lot of deep thinking up front to do all this planning and kind of try to see all the unforeseen things. And then a month later, it's like out the window because there's another variable that entered. And it's like, oh, I just did a month of business planning and it's out the window because this happens.
Analysis paralysis.
Exactly. The descriptions of founders where you like jumping off a cliff and building the parachute on the way down is that you have to, because you don't know what those variables are tomorrow and what you have to face. But you've got to be nimble enough to make those decisions and build on this iterative process that you talked about.
Yeah.
But I think one thing that Paolo's unusually good at is killing your idols, right? Like not getting married to an idea and being able to say, nope, that doesn't work. I'm going to sort of move on. And I was sort of curious if there were any good examples of that as you were
product.
building software, right? I know of that one in particular.
That was a ill-conceived idea. It worked out, but I think through that process, we sort of realized that we can't solve all of our own problems, and it's not our domain expertise. And the wider you get in what you're trying to make, to be good at, you end up becoming this jack of all trades, master of none. We knew that in order for us to build more connected ecosystem, it wasn't through us becoming product people. It was for us to find people with focused solutions like startups. And what we realized is what they valued most was feedback. Mm-hmm. We were desperate to give feedback because we needed improvements everywhere.
Yeah.
So that was really what started our journey into venture capital, was really from that process of like realizing, okay, we're not going to build some 5 amazing products that solve our 20, 30 problems, right? It was, we built this one solution, we doubled down on it obviously later on and found a brilliant CEO to run it and build the product and build it into what it is today instead of throwing it in the garbage. But what came out from that was, okay, if we partner with early stage solutions, we give feedback to those solutions, we can help those solutions become much more capital efficient. And they then will value that because they're not sort of pivoting in the wind, trying to figure out what the customer wants, and which is really difficult for startups, especially in the real estate space where adoption is really difficult. We were thinking about originally as outsourced development, almost we could look for solutions, look for problems that we had, find somebody focused solely on that problem and really push them to make something where they would listen to us. We knew we could bend their ear early on enough that they could. And you also had to make sure that they were well funded enough that you were going to spend all that time and then for the solution to disappear. Yeah, that was sort of the MO, which over time we started to realize, well, okay, this is somewhat differentiated. We should be taking a bigger stake in these businesses and investing alongside. And we liquidated that first fund. We went into more institutional multifamily. We started to grow into other asset classes. We got into development. So it sort of naturally evolved where we were looking at a much broader spectrum of real estate than we were originally. And then obviously our service businesses, right now we don't do maintenance anymore because maintenance is really part of our management services. Construction we still do, and then property management we're sort of growing out third party for the first time. We have like a nice core to reach out to and look for solutions for, and a lot of our core businesses are coming to us with problems that they need solutions to.
Paolo describes how their journey into venture capital evolved naturally. They began by investing in startups addressing real-world operational challenges in the real estate sector, like inefficiencies in maintenance and property management. Their approach emphasizes backing founders who are resourceful and focused on solving practical problems, rather than those driven solely by big-picture visions without tangible execution. They believe this focus on fundamentals leads to stronger, more impactful investments, while at the same time offer solutions to their initial investments.
So back to, as he's going through this, you're selling your business and then you're looking for options. Let's talk a little bit about that.
Yeah. So, I think I started from, Paolo started very focused on the real asset, right? I started very focused on the sort of funnel of financial opportunities in real estate. And so first figuring out, did I like being an LP? Did I like development? Was value add an interesting strategy, right? Because I was investing out of a family office at the time.
And what are the differences, right? Someone asked questions for education. So what are the differences between the work of an LP and the work of some of the other things you described?
Yeah. So, I mean,
and the limited partners, what that means. So
I mean, just the basic structure of every real estate deal is you have the propco, right? So the company that owns the dirt and the building and everything that's on it. You have LPs, which are your limited partners, right, that inject the equity into the business. And then you have the GP who manages the business and the operations of PropCo and the reporting to and communication with the LPs, right? So when you think of somebody as like a developer, right, or a quote unquote owner of real estate, oftentimes you're talking about that sponsor, right? The person who, or team usually, or company who comes up with the idea and then goes out and, puts together everything from buying the asset to financing it.
So that would be more the GP.
That's the GP's role. Yeah. And then the LPs are, generally acting on behalf of somebody who's allocated them capital, right? Maybe it's a pension fund. We talked about, there's this distinction between high net worth and institutional that you'll hear a lot in real estate. Generally speaking, institutional would be these larger groups like an endowment or a pension fund who are aggregating capital, or maybe it's an insurance company, maybe it's a private fund, but they're aggregating capital from a bunch of investors and then investing it into real estate on their behalf.
Right. And then the high net worth are individuals that just want to make more return on their money and they want to invest in real estate, and they don't want to go the traditional mutual fund way. They were like, I want to invest directly.
Yeah. And oftentimes those are your investors that you have access to, right? I mean, I knew that I tended to have the best financial outcomes when I was both an investor and an active participant in the business. And so I got really interested in development, specifically multifamily at that point.
So does that mean you were a GP and an LP together?
Yes. Yeah. So that was the idea, right? Is getting into real estate after looking at all these different kinds of businesses and saying, okay, I think there's some opportunities to do things a little bit differently here. Here's my set of learnings or observations. And so how can you then go apply that basically to raw dirt,
right?
And then go through first the entitlement process, right? Which is the either zoning or getting a development permit, and then followed by, financing and actually building and operating the business, which is sort of a 3 to 5 year timeline. And so that sort of organically grew out of, being just an LP at first.
Right.
In summary, LPs are passive capital providers, while GPs actively manage projects. Investors range from large institutions to individual wealth managers, each with unique goals and investment strategies. In Matt McDonald's case, he found that financing a real estate investment and managing it at the same time enabled him to be most successful.
One of the things that I recall talking to you either on an earlier podcast or just over coffee is that some of the things that you looked at were some of these old properties that had some either legal issues or just things that just weren't, it wasn't an easy transaction. And you saw that as an opportunity to focus and be your niche.
Yeah. So, I mean, I had a law degree, right. And a finance background at this point. And so I sort of looked at the world of opportunity, and I think like Paolo saw, you got to solve the problem, see where you can, do something interesting. And what was happening is I would look at a property, and if I underwrote it, let's say I thought I could pay $8 million for the property. Well, somebody out there had a cheaper cost of capital, and so they could pay $10 million, right? And so I'd lose every single time if that was my approach. And so the only way to deal with that was to go figure out, okay, can I go put tax credits on this property, or are there perceived risks like floodplain issues, where, I can actually go figure out how to take the asset from where it is today to something much more valuable, and therefore other people are going to discount it more than I will. So those were, it was sort of out of necessity, right? And having the ability and the willingness to go sort of incur the brain damage, so to speak, of figuring out incentive plans or what have you.
And then going back to the story of when you guys met. I mean, obviously you met through a mutual friend or something of that nature, and I got to know each other. And what was it about Paolo and what he's doing that was attractive to what you had just completed?
I mean, I think it was sort of what we were talking about, right? Like we were both hustling. I mean, one of the things that I love about Austin is that, people are passionate about what they do. And, we had both arrived here because this was sort of the platform that we had decided. And then, just watching, we did this funny deal together. Funny in that it was somewhat atypical. It was a revenue-based financing deal. So I found this company in Ohio that if you were to say Google your favorite book at the time prior to this business, you wouldn't find those search results on Google, right? So the library's data sets didn't talk to search engines. And so they invented a data structure that allowed that to happen. And so as a result, you would increase circulation for the library, which would increase funding. And then sort of all the feel good, democratic access to information kind of things too. And so I put that deal together and that thing, we funded it. We eventually got paid back right before the pandemic, as a matter of fact. And I think that in going through a deal or two together, right, you sort of get an opportunity to see how each other think, right? Or I had invested in a fund that Paolo put together. And there was a project in New Jersey at one point. There were a bunch of different sort of little pieces. But I think that was it, right? It was just sort of, VCs often say that they invest in trend lines, right? Not data points. And I think that was sort of what was going on during those years, as we were both coming up alongside one another and, sort of sharing that information, but also having absolutely no free time, right? So it wasn't like, it was like, let's catch up for lunch, and like we'd schedule it, way out in advance, and we'd try and squeeze it in because it was helpful, but it was, we were both running two businesses.
What that conversation looked like, you know what, we should do something together. I mean, we've invested together. We should actually build something new. I mean, what did that, like, what sparked that idea or that conversation?
Yeah, I mean, I think I had launched the fund, raised the initial capital from our existing network, had a bunch of deals in there, had been doing sort of this for a couple of years, but I think was looking for a sort of complementary skill set to my own to help scale it and take on too much for one person to do. Matt had both an atypical background for somebody to go into real estate VC that I thought was attractive, where one, he has the experience operating real estate directly, also has experience as an entrepreneur, which is sort of unusual, and had a network that he had raised capital from prior and could access that capital to help grow and scale.
And our networks are, I think, really complementary too, right? There's not a ton of overlap in that Venn diagram, which has been helpful.
Surprisingly.
Yeah, and surprising.
Yeah, especially since being in the same city. On the real estate side, we had high net worth for a little while, but then went right into institutional. And then our first LP fund, they came to us midway through the fund and were like, okay, let's do fund two, same terms. I don't know. I don't think I want to do the same terms. So then it put us in this situation where they basically said, all right, well, if you don't want to take these terms, go find your own capital. We did. And so we found sort of larger institutions from there to sort of back our fund two, which wasn't really, we raised a GP fund as opposed to another LP fund, which there's a distinction where
one, you're just being investors, and the other one, you're going to be an investor operator.
The way the structure works is where it's typically 10%, like the GP side is 10% of the equity check, sometimes greater. Your LP is 90%. The LP has oftentimes preferred terms over the GP. So you have a bit more risk investing in the GP side, but more upside. The LP has less risk, but if you're into the promote, you're earning a promote off those LPs. If you perform well, then you start, taking away sort of some of the splits from that LP into the GP. And our GP fund, there were shared economics with those LPs into the GP side. And we also put our own money into that vehicle.
Okay, to break this down, the GP typically contributes 10% or more of the equity, while LPs contribute 90%. LPs often have preferred terms, meaning they take on less risk, but also less upside. GPs bear more risk, but can earn substantial upside through a promote, which is a share of profits above a certain return threshold. And furthermore, in their GP fund, they shared economics with LPs and invested their own capital, offering flexibility. This structure allowed them to realize carry profits as they exited individual properties instead of waiting for full fund liquidation as in traditional LP funds. They could also hold selected assets long-term instead of selling everything within a fixed time frame.
So we like that from the perspective of it gave us optionality, which turned out to be a pretty important thing because we raised that fund in 2020 and we're able to exit out of a bunch of properties where we perceived the top of the market. It ended up being in 2022. So the great thing is we could realize our carry on every investment that we sold, as opposed to a traditional, LP fund where you are waiting until the very end liquidation to receive your carry. And we could actually pick out certain assets that we wanted to hold for longer periods of time, which we're still holding some of those assets, as opposed to being forced to sort of sell everything within a certain window.
By raising their first fund in 2020 and exiting properties around the market peak in 2022, they maximized returns and adapted their strategy for changing conditions.
There's ways around that, obviously, in an LP fund, but you can sort of recap out your current investor and find new equity.
Raising capital is never without its challenges, and this became evident as the team transitioned from their first fund to their second. In their initial venture, the use of discretionary capital granted them the flexibility to adapt and seize opportunities. However, their second fund introduced a different dynamic, relying heavily on institutional limited partners. This brought with it a more rigid structure, limiting their ability to maneuver as freely. Adding to the complexity was the state of the market itself. Dislocations created uncertainty, causing many institutional LPs to hesitate, adopting a wait-and-see approach. Even with a proven track record of success, the team found themselves navigating a landscape where capital became harder to secure. It was a stark reminder of the challenges that come with changing market conditions and the evolving expectations of investors.
The type of structure that you chose to build this business was both investment and operator, and you built certain items into the business structure to where the better you did, you got incentivized from the LP, which are the investors, to bring more of that as you perform better, bring more of those points to you so that you had more control of that. And then you could also walk away and be selective in which properties you wanted to keep by positioning other LPs in. Did that more or less what you said?
More or less.
Okay.
I think one of the big distinctions, right, is in real estate, and sort of like a foundational choice about how you capitalize it, is you want the assets commingled in a fund, or do you want them capitalized separately, right? And so it was that separate capitalization that allowed, and sort of as a strategic choice too, that allowed them to be selective.
Got it.
So what to sell when.
So each property is an individual silo versus all together.
That's right. And it also gave us, like, the biggest thing from our performance standpoint was every time we sold a deal, we were collecting the carry.
And the carry means what?
The carry is our promote.
Profit.
It's like what we get off of, well, one, profit from the deal, but also the promote structure from the LP, which, if you really hit it out of the park, can be pretty substantial, and was substantial on some of these properties for us. So is a better incentive for timing the market and doing things. It aligns you a little bit better with everyone, like LPs, your GP, LP, and all the different parties in the structure. But the other thing that we were considering, and why we did this coming out of our first fund, was you also don't have the same drag on cash of unallocated cash, because we had this reinvestment period in our first fund, and we were buying all these small properties, selling them, trying to reinvest that cash. So the cash sitting idle would be a drag on returns. Whereas there's no drag. We were thinking, okay, what's best for investors? What's best for...
So anytime cash sits in a bank and it's earning 0.1 or 0.5 or 1%, it's not working.
Yeah.
So that's the drag on.
Well, now it's different.
Right. Now it's earning like 5-6%, but back then.
But it gets added to your weighted average performance, right? So if you have, half of your assets in cash and they're earning effectively nothing, and the other half is earning 20%, right? You've just halved your performance. Right. So, and then that makes it more challenging to raise cash in the future.
Yeah. I mean, from an LP, all they care about is post-tax, but what all they care about is what's the net of everything. Like, what do I get? What's my net?
What's in
IRR?
it for me?
Yeah.
At the end of the day.
Exactly.
And the downside, right, is that then you have to raise capital every single deal, right? So it's not, I mean, I've always capitalized my own real estate projects this way because I do like the level of alignment, but the downside, right, is that then you don't just have this pool of capital that you can call on demand when an opportunity comes up.
So
and it's sometimes difficult to convince, like, I think the most difficult part, which we see now, is you've got LPs that are sitting on cash. It's difficult to convince them which we're not necessarily in that place right now, but if you're in a really sharp consolidation, it's difficult to convince them to buy when there's blood on the streets. Because they're like, I'd rather wait until there's a clear indicator that we're on the way back up.
Right.
And so I think you miss a bit of opportunity there, where if you're, more forward thinking, you raise discretionary capital, you have that capital available, you can deploy it when you think that the optimal time is.
Yeah, that makes a lot of sense. That was very enlightening from a business structure, from a LP, GP standpoint, because I know a lot of people that are interested in real estate hear these terms but don't understand how this actually works, and so that was very enlightening.
Paolo and Matt's business model seamlessly integrated investment and operational roles, aligning strong performance with incentivized returns for limited partners. This approach ensured both long-term flexibility and a shared commitment to success. However, the choice of fund structures introduced inherent trade-offs, balancing adaptability with added complexity. In the context of shifting market cycles, they emphasize the challenges brought on by rising interest rates and reduced liquidity. These changes have redirected capital allocation away from speculative ventures and toward businesses with solid fundamentals and immediate value propositions. Despite the tighter funding environment, they see this as a unique opportunity for patient investors to identify and support early-stage companies with sustainable growth potential, leveraging their flexible model to navigate these evolving market dynamics effectively. Stay tuned for Part 3 with Paolo Boero, where we discuss the intersection between real estate and technology.